And we're live. G'day, I'm Scotty North. This is Xenium.Live, all things money, finance and property. And we're at a little bit later today. We had some technical difficulties from our bunker on the Sunshine Coast, trying to get the signal out there to the global audience that we seem to entertain every time we're on the show. All right, today is a Thursday afternoon and I'm joined by the wonderful, the only PJ Patterson from Keystone Financial Services. G'day, PJ. How you going?
Scott, I'm good. I'm out on the road at the moment. As you can see, we're traveling down the highway here on a road trip. And, I've got the people in the back of the car asking, are we there yet? Where are we? We're headed towards that mountain right there. It's like we're in a black hole right now. We're only traveling very, very slowly.
Okay, that's wonderful. And look, you did raise a very pertinent topic there, is that I called it this today, are we there yet? And the main reason for that is because a lot of times over the past month, I've been talking to people, as you do, and I'm hearing things like, oh, we've been through the worst of it. We're up to the point where we're going to have a recovery, or no, we haven't hit the bottom yet, or even the next comment is, prepare yourself, batten down the hatches because it's only going to get worse and we're about to have a crash. So I thought, let's talk about that as our market update for August, which is what we get you on for. And mate, have you been hearing the same stories, and what's your take on the matter?
Yeah, look, it's we're in very interesting times. It might be worth just recapping where we've kind of come from and where we are at the moment, and then look forward to maybe where we're headed. So if you recall, we've had this thing called COVID, I don't know if you're back or not. The Queensland border's been shut, the Victorian border's been shut. It's just madness out there. But we had a complete and total economic collapse in April and May of this year, global economic collapse. It was horrendous. Everyone was shuttered at home, and it was just super, super bad. Everything, all economic metrics went off the cliff, and really bad situation for a couple of months. We then entered a period of what many are calling the reopening of the global economy. I've heard the phrase the reopening of risk, and I think that's probably a slightly more appropriate moniker for that. And that sort of started at the end of May, and we're sort of coming to the conclusion of the reopening. And so what that looks like, of course, is the people went back to work, and we relaxed a lot of the restrictions in the global economy and the local economy, and kind of that wait and see what happens. Are we going to get a second wave of COVID or whatever? And of course, we did start to see second wave coming through in both Australia, overseas, in the U.S., in Europe, and I think in large part right now the authorities are probably trying to figure out how to deal with that. So what we're entering now is a period, we're almost in September. The September to December period is going to be really interesting to observe and to live through, because we've got the reopening of the economy, which has occurred, and we now have this return to, I don't want to use the word normality because I don't think the world's going to be normal again for a very long period of time, but we've got some form of return to normality, but we have a few things lingering that are potentially going to be the boogeyman under the bed that might jump out in sort of November, December. And this really revolves around things like the stimulus programs and the mortgage pauses and all of the stuff that the government has done and the authorities have done during the last couple of months of this situation to alleviate or help consumers and help people get some relief from creditors and from the fact that they might have lost their jobs or had their pay reduced, that sort of thing. And so many of those programs, I think we talked about this the last time I did an economic update, but many of those programs and initiatives and mortgage pauses and all of that are going to effectively finish in that November, December timeframe. Now, a couple key things, macroeconomic factors that I just want to put on the table for everyone to sort of think about. We know that we've had a real situation with the jobs market here in Australia and overseas. This is going to be one of the key drivers to economic activity going forward. What happens with people getting back to work, small businesses opening again? Will that drive confidence? Will it get consumer spending up? All this sort of stuff. Those are the things that are going to really start to rejuvenate and drive economic activity in Australia. Secondly, we've got, of course, super low interest rates and a commitment from our Reserve Bank here in Australia that they're going to keep interest rates suppressed. They're going to keep them low for a very long time. They pretty much said next 2 or 3 years, don't expect rates to do anything. It'll be interesting to see how this plays into the market, and we'll probably talk about first home buyers and some other stuff potentially during our time today. We then have government spending. So I think I talked about this last time we had an update as well. The Australian national balance sheet is actually quite strong. Our debt to GDP ratio is only about 44%, which is a very, very good metric, which basically means that the Australian government still has a lot of dry powder that they could throw at this situation. So effectively what they'll do, of course, is they'll print money, they'll deficit spend, they'll do whatever it takes to try to get the economy fired up again or continuing. If we get a little bit of fire going in the economy, they'll want to stoke it. So I would fully expect to see the Australian government coming out with more supportive measures, especially if they start to see signs that things are not going to continue improving in the back half of this year. But one of the main things that we are probably going to struggle with is, and again, I've talked about this in our previous update, is the fact that we're in a stagflationary environment. So we are in an environment where we have low growth and we have inflation. And that is stagflation for those of us who, now I was only a kid in the 70s, but for those of us who lived through the 70s as children or even as adults, you would remember very well that that is not a very fun environment to be in at all. So those are some of the macroeconomic, bit of a recap of where we've been, where we're at, and where we're going, a bit of the macroeconomic factors that we'll have to probably consider. So there you go. That's where we are at the moment.
Yeah, that's good. So how does that play out in the past month? It's always talk about the stocks and shares and equities markets, because that's what our update's about, specifically at this point. So what have you seen in the markets this month, and how have they reacted to certain things? And are we seeing any reaction, especially in the US, to as we get closer to the US presidential elections?
Very good question. So the markets at the moment are seemingly on fire. So we're seeing new highs, particularly in the US, in the S&P 500, the Dow, and particularly in the NASDAQ. And it's a little bit of a mirage, because something like 62% or thereabouts of the S&P 500 constituents are not making new highs. In fact, they're barely off where they were during the market crash. So there's only a small percentage of the market which is actually driving the market. Now, luckily, I suppose for the market indices, it's the really big names like your Apple, Google, Facebook, Amazon, Tesla, some of these names that are really heavily weighted in the indexes. Those are the names that are showing the leadership and driving the markets higher. The market, though, isn't really the economy, in the sense that even though you see a stock market that might be performing well, it doesn't necessarily follow that everyone is feeling wealthier or is in good shape. In fact, it's probably the opposite. And whilst we are seeing the stock markets at the moment, there's some uplift there and some positive signs there. The person on Main Street, I think, is still probably suffering pretty badly. In fact, there was a statistic that I read just recently. Let me just grab this and I'll make sure I get this right. This is in the US, and I don't see why it would be much different here, but it's a stat that 62, I'm just trying to find it, 62% of small businesses reported that they needed to see consumer spending sort of return to the, or to return by the end of 2020 in order to stay in business. So basically they're saying, small businesses are saying, we need the consumer to come back. We need them to spend money in our establishments in order for us to survive. And one of the things we've seen over the last couple of months is excellent support from the Australian government for small businesses and stuff. But the reality is, if businesses don't have customers coming in and spending money, they still have rent, they still have utilities, they still have staff or team to pay, and it's eventually going to become, another problem for the economy. So still some, still some very interesting things to be on a watchful eye of.
Okay, and so with that in mind, I mean, it's not even steady as she goes, right? I mean, it's almost turning into, I'm not going to say a them and us or a two-speed style economy where we see some of these styles of companies that are making more money than they've ever made before, but the majority, as you said, a large majority, is sitting there exactly the same as they were in the middle of the crisis. So nothing's changed.
Nothing really has changed markedly. Well, actually, I shouldn't say that. A lot has changed. One of the things that has changed, particularly in this cycle, is we've seen corporates taking on more and more debt. Now, this is mainly a function in the US, but I suspect there'll be a little bit of that happening here in Australia too, where every time we go through an economic cycle, when I say cycle, I'm talking about the expansion, then a contraction. Those are the two broad things that occur. You go through an expansion period, then you have a contraction. And during the expansion period, of course, a lot of businesses will take on debt. They'll try to grow and they'll take on a lot of risk. And we have a contraction, which then cleanses or cleans out a lot of that stuff. And one of the problem areas that we've got at the moment is we're not seeing corporate balance sheets being cleaned up. In fact, they're growing, and this is not a good sign going into effectively a recessionary period. So we've had a depression, which was the effectively total economic collapse that we experienced in April and May. Transitioning out of that into a recessionary environment, that's not great for corporates. So what we really need to start seeing out there is the repair of corporate balance sheets, the reduction of debt. We need to see probably some businesses failing, and just that whole cleansing of that part of the economy occur before we can really say that we're getting out of this situation and into or towards better opportunities and better times.
Yeah, look, that you make a good point there, and I'm going to ask you about that in a sec. We've got the wonderful Michael Carr has joined us. Hello, Michael. How are you going? Thanks for listening. Appreciate you jumping on and watching. And if you do have any comments or questions, you can always jump on our live shows and type your question in the comments box, and we'll be able to answer it live, as long as it's appropriate, right? We don't, we got to screen the questions here. So the question I had to you is, PJ, if that natural cleansing process has to happen, but if it's not let happen, like if someone with a business is deemed as an essential service and government doesn't want it to go, so they're on sort of life support and not let to die, I know it sounds really harsh, we're not going to be out of this sort of type of environment anytime soon. Am I right?
You're 100% right. And this is, in fact, what the Japanese have basically been in a zombie economy for the last 20 years because they didn't let that happen, particularly with their large banking institutions. And so hopefully, the central bankers and governments have maybe learned from some of those mistakes that were made in other countries. I doubt it, because their answer to pretty much any crisis these days is just to print money and go deeper and deeper into debt. So it does pose an interesting question, which is, if I dare say it's probably not the essential service businesses that are going to be in jeopardy, because of course they're going to continue trading and operating through this. I mean, the example stands, obviously, that you're really just saying if there's a weak business that for whatever reasons receiving some support or some government support or a reduction in rent or something like that, and they really just should close up shop, just liquidate, go bankrupt, or do whatever, and hit the reset button. If those businesses don't do that, then yes, we could see this drag on for another year or two, and effectively then when the day of reckoning shows up, it'll be even worse. I don't necessarily have a view on this, because I'm actually reasonably positive on the Australian economy. I think we're starting to pull out of it, and a big part of that is the fact that we are situated in Australasia, and emerging markets are a big driver right now of global growth. So when the US dollar, which is basically in crash mode at the moment, when the US dollar is falling, it's very, very good for emerging markets. And if emerging markets are firing up, that means they're going to want more commodities. They're going to want more of the stuff that Australia digs out of the ground and sends over there for them to turn into finished products. So I think that's probably going to be the saving grace for Australia, is the fact that we will have China and Taiwan and South Korea and some of these other economies over there, Indonesia, Thailand, who are all doing reasonably well by comparison. They're recovering a lot faster. As long as there's not some COVID outbreak or something that causes them to have to shut down again, then we should see them pulling Australia along. And then hopefully a year or so from now, once the rest of the world gets their act together, Australia will already be, sort of firing, and then off we go.
Yeah, look, and without getting too political, we've seen a lot of articles in the news over the past few weeks about China being upset with the way Australia is and other bits and pieces. And I think there's a lot of chest beating and politics going on that side. But at the end of the day, what you're saying is that the ability that the fact that we're the world's mine is going to save us once again, and like it did last time.
Yeah, very much so. I mean, it's certainly going to help us get through this. Now, we're going to need to see, obviously, we're going to need to see the return of tourists and people visiting our lovely and beautiful country. A big part of our economy is obviously international students that come in. It's the people that travel here and spend a lot of their hard-earned dollars that they earn overseas in our cafes, restaurants, hotels, and all of that. So we do need to see the return of the hospitality and tourism industry. We need to see people coming back to Australia. That'll really bode well for us. But in the interim, yes, I think the fact that we got a lot of stuff in the ground that a lot of people around the world need. I love that idea that we're the world's mine. It's very true. That should help us weather this storm a little bit better than maybe other parts of the world.
Yeah, okay. All right, so moving on, we've had some couple of comments I flashed on the screen there from viewers as well. Michael's saying that he feels as though the government is trying to save as much business and people as possible. I think you're probably right, Nick. And Australia is well positioned and we'll get out of this 100%. Well, yes, we will get out of it one way or the other. Whether we're owned by China or owned by ourselves or whether Victoria falls off the state of Australia, who knows what's going to go on, but one way or the other, we'll find the end of it. What I want to move on to now, PJ, is we're still in this time of, as you said, like not much has changed. We're not there yet. So the question asked is, are we there yet? We're not there yet. So what are you recommending your clients still do at the moment? And what are the key indicators that you're looking out for?
Great question. Right now, we are positioning ourselves for inflation. We are owning and we're positioning ourselves for continued low interest rates. So pretty much right now, I believe that you want to own assets that are tied heavily and closely tied to the interest rate environment, as well as the fact that we're going to start to see inflation. Now, we already are seeing a lot of inflation. So inflation hedges like gold, silver, gold miners, commodities, all the softs, oil, to a lesser degree, oil, natural gas, all of this stuff, they have been on an absolute tear. In fact, you've seen outperformance and things like that versus the ASX 200, the All Ords, even the S&P 500. Commodities have just been ripping at the moment. And so what they're doing is they're signaling that we're going to continue to see inflation. Now, for those of you listening and watching to this, there's a very important meeting. Federal Reserve has their annual conclave in Jackson Hole, Wyoming. Now, they're not doing that this year. They're doing it by teleconference, but it's a really big event. It's their annual retreat. And there's always a big statement that's comes out of it from the U.S. Fed chair, who's Jerome Powell. And that's on Thursday night. So Friday, or probably early Friday morning, Australia time. He's expected to pretty much come out and say, we're going to target a higher rate of inflation. I'm probably paraphrasing, but that's effectively what the message is going to be. They have been unable over the last 10 years to create any meaningful inflation. And it seems astounding that they want to do this because that hurts you and me. That's the silent tax on us, our earnings, everything else. So it's not great for individuals, but the government needs it because they need to inflate away their debt. But the reality is that it's going to potentially get out of control. And so one of the things I'm looking for, I'm not saying there's going to be hyperinflation or anything like that, but we could very well see some real pressure on things like fuel prices, food, again, all of the soft commodities, meat, those sorts of things. And if we see continued sort of shutdown in our economy, we could continue to see issues with drought and and the prices of agricultural goods in Australia rising for no other reason than we just have shortages, and we're not able to either grow it because of drought or it's not coming in the country because it's just harder to get stuff into the country. So that's probably the area that I'm positioned right now. Tech is another big one. So technology stocks in this particular environment, the organic growers, the Amazons, the Facebooks, the Googles, all of these sorts of technology companies, they kill it in this environment. They do well typically in every economic environment except for a depressionary environment, which we've just come out of. But I suppose to just wrap that up in a nice bow, inflation hedges, interest rates, so that would be government bonds, utilities, real estate, investment trusts, things like that, gold, and technology. Those are the sectors right now that I'm weighted into.
All right, now that's good. This article came out this week from the RBA, and depending on which, I guess, news outlet that it came from, depending on what they focused on. But in essence, there was a line in the article from the RBA which talked about a fall in Australian house prices and how strong our banks are or aren't, right? This was a report on this. And it said a 40% fall in Australian house prices is an extreme but plausible scenario, according to a Reserve Bank of Australia discussion paper on household debt. Now, 40% is fairly large. So, of course, all the doomsayers grabbed that headline and ran with that, and that's fine. I mean, that's how they do stuff. They also went on to say that the banks appear resilient to a severe downturn, that most household debt is held by those who can afford it. Now, I found that line interesting because I don't know the exact stats, but I would suggest a 40% fall in house prices is extreme but plausible. And I'm not saying that's going to happen. I'm just reading from the report. If that did happen, I would question the bank's ability to remain resilient. What are your thoughts?
Well, look, I think there's a couple of things you have to think about in that article. First of all, just because house prices drop by 40% doesn't mean that everyone's going to go sell their house. And so there's an assumption there that that's a bad thing somehow. I dare say that if house prices drop by 40%, that most people probably would not sell their homes. So if anything, we'd see a quick recovery. So I think that's a bit of sensational journalism that's actually just BS. And they've been trying to say we're going to have this massive correction in house prices in Australia for a very long time. Now, we might get some sort of correction. And remember, over the last couple of years, we have had prices, they've just been slowly going up, or we have had some pullback. And specifically in areas like investment lending, they've really done a good job of trying to curtail the speculative bubble nature of Australians, going and bidding up property prices for investment purposes. Now, onto the question of our banks and their solvency. Certainly, our banks have been through a number of stress tests over the last, I'd say, decade. After the GFC, the APRA, and the government wanted to ensure that all of our banks, and particularly the big four, were solvent and could remain solvent through this sort of crisis coming up, which was very prescient by them. That was a good call. One of the things that has happened of late, so in the last probably 3 months, is APRA's come out and said to banks, no more dividends. You have to, I don't think they made it mandatory, but they sort of strongly suggested to banks that they should not be paying dividends to their shareholders, and instead putting that capital on the balance sheet so that if there were any problems, that the banks would be able to have enough capital to deal with it. But, I think at the moment, the Australian financial services and banking sector is in good shape, but it's a big but. The banking system is a confidence system. So we've talked about this before. If you went to withdraw cash from your account, the amount of cash that the bank has on hand to give to deposit holders is probably less than 1% of the total amount of deposits. So if everybody turned up to the bank tomorrow asking for their money, so cash, there is literally not enough physical currency to supply that. So that's what happens when when bank runs and things like that start, is people lose confidence because they can't get their cash out. So we live in a digital economy effectively. So I can't see that something like that would happen in Australia. I think Australians are a bit smarter than that. We also love our real estate. So there's a large number of people who are owner occupiers and certainly would not be selling their house if it dropped by 40%. They'd be pissed off. They'd probably be going to the government saying, guys, you got to fix this. But I don't think they'd be running out selling their houses. I think the key thing to really link into this conversation is employment and jobs. People can't pay for a mortgage if they don't have a job. So that's probably the key thing that we need to keep our eyes on our fries. The fries being the jobs market. If we continue to see jobs deteriorating, unemployment rate rising, and not beginning to recover, and jobs not being created, that's when I think you're going to start to see more and more problems showing up in the mortgage market. I think the banks have provisioned for, possibly 1 out of 10 of their clients who are on deferrals, maybe, not being able to come out of that and listing their property for sale. But I've got to ask the question, what opportunity will that actually present for example, first home buyers or people who have been marginalized, not able to get into the housing market? There could very well be a whole class or cadre of people out there who are like, bring on a 20% drop in prices because we're ready to jump in there and buy.
Look, I agree with you. I mean, property is the main focus of what I do for my job, but I mean, I couldn't care less if prices go up or down. It's about you transacting in the market at that time, and if prices go down, there's some great opportunities for our clients, and we're willing and ready to act on that if and when that happens. So I 100% agree with you. I don't see that as a big deal, and I totally agree that the ability to pay for the house is the big deal. Who cares what prices are as long as someone can actually pay for it?
Oh, yeah. And it's a pretty well-known fact that a lot of Australians have a number of months of mortgage payments in either redraw, offset accounts, or even just sitting around in cash. So I think, look, we haven't really had a big property correction of any description in the last 25 years in Australia. We've had our moments, we've had some hiccups, and typically what you find is whenever we get into real economic carnage, kind of like where we're at right now, is you tend to see the lower socioeconomic classes getting hit the hardest. So the folks that are right on the margin, the real blue collar, unskilled labor types that live in the city fringes or that are 25 to 50 Ks outside of the CBD, where the property typically, when we're in a property boom, those properties they run hard and fast. And when we have economic carnage, they also run hard and fast the other way because those people are more likely to lose jobs and all that sort of stuff. It's, the core of cities, of capital cities that, 5 to 15K radius, maybe even out to 20Ks, usually find those people are the professionals, the business owners, and all that sort of thing. So, look, I'm not going to start ringing the bell on this. I don't think we're at a property top or even any of that. So I think we just tick along, really, in this market.
All right. So to answer the question that was posed at the start, is that are we there yet? No, we're not there yet, and we really don't even know how long we've got to go. So perhaps the GPS isn't working properly at all, mate.
Well, we haven't really moved, have we? So and that guy in front of us has been there now for a while. So look, I think we've got another economic update in another month or so, and I think by the time we get deep into September, we're going to start to see what the economic data is telling us. We're going to see the reactions from the central banks. We'll get more economic employment information to see what's happening there. And of course, if we have a resurgence of COVID, we'll know in another month whether we're going to have continued shutdowns. I mean, the states just cannot keep their borders shut. It's ludicrous that they even are shut right now. I think there must be a good reason for it. Pardon me, but I think they're going to effectively start killing off their economies even more than they already had during the initial shutdown. So there's a lot of people, not happy about that and wanting to see the return of movement of people around our great nation.
Look, here's to that, and I agree with you wholeheartedly. Look, PJ, thank you very much for joining us today. That's PJ Patterson from Keystone Financial Services. This is Xenium.Live, which is all things money, finance, and property. And you can join us on a replay on YouTube or Facebook, and you can catch us on our podcast, which is Xenium.Live on all your favorite podcast players and apps. PJ, thanks again for joining us, and really appreciate you coming along. And we'll see you in a couple of weeks for our next topic that we're going to talk about, and 2 weeks after that for another market update. Thanks,
Sounds
mate.
good.
Thanks for joining us.
Looking forward to it. See you next time.
All right, I'm Scotty North, Xenium.Live, and if you've got any questions or feedback on these shows, hit us up. You've seen it scrolling at the bottom of the screen for the whole show, or for those listening to us on our podcast, go to www.xenium.property, and you can email us at hello@xenium.property. No .coms, no .aus. We just focused on what we're focused on.